moving forward. Our process with Bitcoin is very unique. There are no earnings reports. There's no 10K reports. There's no revenue analysis. There's no management team. There's no competition. Some might want to argue with me that maybe Litecoin has a shot. I think that's a dumb argument. Bitcoin is the de facto winner of the digital store of value. So what moves price? If it's none of the standard metrics that move equity prices. Most people assume it's narratives, things like the strategic Bitcoin reserve or ETFs being opened up to institutions, opening up, the possibility for institutional adoption, which those are very bullish narratives. But if you use narratives to invest in Bitcoin, it's arguably one of the worst strategies you could do. I mean, look at this. This is Bitcoin going back to 2016. The first future contract was launched at the top in 2017. Very bullish narrative, and it marked the top. Elon Musk puts $1.5 billion worth of Bitcoin on Tesla's balance sheet right at the first top in 2021. We saw about a 40% drop from there. El Salvador, first country to adopt Bitcoin as legal tender, extremely bullish narrative, and that marked the top of the most recent secular bear market. What happened here? Oops. Sorry. So anyway, sorry, I went forward by accident. So narrative investing was a terrible plan historically, and even on the downside. The most recent was the FTX scandal. I mean, that was one extensive fraud after a string of bankruptcies in that bear market. But the narrative around that failure was that this was going to destroy the faith in Bitcoin, and it was never going to recover. And we're up, what, 700% since then? So narratives are not the best way to approach Bitcoin when it comes to investing. And history very clearly tells us that. So what moves price? Is it random? And it's certainly not random, not from our analysis. So two things that we look at. One is global liquidity. I'm not an expert in liquidity. There are people like Michael Howe, Darius Dale. These guys are geniuses when it comes to global liquidity, and they have very detailed models that will address this. But from our analysis, just to kind of give you an idea of how we apply this within the Bitcoin world, what I mean by liquidity is the availability of capital within the system, the global economic system, specifically how easily businesses and consumers and financial institutions can access credit. You cannot, so how easily can you get a loan and roll over a loan? And you can't talk about loans today without talking about collateral, because 80% of all lending requires collateral. So how easily and cheaply can borrowers access collateral like treasuries, like real estate? All these things affect liquidity dynamics. And so the most important factor, or probably the most popular factor that controls liquidity dynamics is central bank policy, right? And if they're raising rates or lowering rates, that's going to actually increase the ability to access credit, supposedly. But what I would argue is the most important, if not the most important, or one of the most important, is the US dollar. 64% of all global debt is denominated in the US dollar. And so what that means is if you're in a foreign country outside the US and you wanted to take, participate in the 0% interest rates that happened for over a decade in the US and get cheap dollars, and you took out a loan, and that's a fixed loan, you got to pay that loan in US dollars. And so what that means is that the US dollar is appreciating against your local currency. You've got to get more of your local currency in order just to manage that fixed yield on your debt. That means that's less money for you to put into risk assets like Bitcoin. On the flip side, if the US dollar is in a downtrend against your currency, then you have to really come up with less of your currency just to service your US debt. That gives you more money to put into Bitcoin and to risk assets. So the logic is there, but there's more than just the logic. If you look at the dollar index, which is basically DXY is the ticker, it's just a measurement of very popular US dollar pairs. And so basically when the green line is going up, that means the US dollar is appreciating. And what that's doing is sapping global liquidity from the system. When it's going down, then that means the US dollar is depreciating against other currencies, which is putting more global liquidity into the system. And what you're looking at in the black line is Bitcoin. Now, while the correlation is not perfect, Look at what happens when the US dollar actually goes on a vertical move up and down. And what does Bitcoin do? You can see a very clear inverse correlation between the two. And it's been active ever since Bitcoin's been trading. Most recently, DXY topped in September of 2022, I believe, which was just 2 months before Bitcoin bottomed. DXY has been in a downtrend ever since, and Bitcoin has been in an uptrend, helping to prove that inverse correlation between global liquidity expanding and Bitcoin appreciating. So, what DXY is doing is of utmost importance to me when it comes to Bitcoin. This is one of the ways that I'll generally manage the risk within Bitcoin. Furthermore, I look at sentiment patterns, which is basically all technical analysis is. It's just the measurement of what the herd is doing and about to do. And if you funnel, human consciousness into a quantifiable system like the stock market, strange patterns emerge. And they emerge time and time again on all time frames, on all markets, and going back throughout history. You can see these patterns like triangle patterns, bull flags, bear flags, head and shoulder patterns, cup and handle patterns, very common technical analysis patterns. They're just measuring what the herd is about to do. The most important pattern within technical analysis is the five-wave pattern. It underpins all of this. It's really what marks a trend. And to give you an idea of what I mean by that, if you're new to this, is if you follow me here, what you're looking at is a crypto, an altcoin that was in a devastating bear market. So whenever it bottomed right here in 2023, the sentiment was just abysmal. And so we got this uptrend off the low with very tepid volume, right? There wasn't a lot of conviction in there. And the assumption was, oh, it's just another bear market rally. And then all of a sudden we got a drop. The belief was, oh, we're going to make new lows, but volume was light on that drop as well. And then what happened? Price went vertical, and this is the key. This is what, when it comes to these five-wave patterns, if you can identify the third wave, then you're in business. The third wave, when it comes to sentiment, is when everybody gets on the exact same side of the trade. Shorts realize they got it wrong and they cover at the same time breakout buyers buy, and those that were early adopters, they want to buy more. So everyone's buying at the exact same time, which causes price to go vertical. And it's usually met with the max volume within the trend and max momentum. The fourth wave is when gains are taken, and it's also where latecomers say, I want to get involved. I missed out, right? And so they start buying from those taking gains, and the fifth wave is a final move higher that happens on lower volume and lower momentum, less conviction because there's less involved. You can call it the suckers rally because what happens after the fifth wave is over is you get a three-wave retrace of the same magnitude. So this pattern is very important for this presentation, and I just wanted to explain it. Now we are going to get into the interactive portion of this webinar.